Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The local share market hit a record high earlier in the week with the S&P ASX 200 pushing beyond 8,000 points for the first time. It's been quite a ride, particularly since late October, with the bourse up 18% since then. So why did it reach that milestone? What next? There's no one better to answer those questions than Matthew Kidman, Principal at Centennial Asset Management. Matthew, welcome back to Fear and Greed.
Thanks, Sean. How are you?
Very well, thank you. Now, we have actually discussed this before, and the market really took off around the New Year period. Then it was trading sideways, and then it's picked up again. So tell me, in more recent times, what is it that's been driving the market to this 8,000 plus level?
Yeah, well, in the first instance, it was everyone got too pessimistic, that old chestnut where people just get too down and too pessimistic about the outlook. More recently, as you said, it bounced, it went sideways, now it's started to go again. And you would think that the local conditions are not helping. The economy is slowing. Every company will tell you that there's been a noticeable slowdown in the consumer since about Easter. There's been another step down. So we'll wait to see that in the economic numbers. As you know, the general economic numbers have been very flat, just holding in there, teetering on a recession over the next 12 months, I would think. And another thing that's not good for the market is the Reserve Bank's kind of swayed back to maybe another interest rate hike rather than a cut, which we were expecting a little while ago. So it's set up for not doing well. But what has happened and what's obvious is the US market is probably 6 to 8 months ahead of us. And the Federal Reserve now has basically told the market it's locking in a cut, probably in September. And most market analysts have got interest rate cuts probably for the next 12 months, somewhere between 100 and 125 basis points. And the market likes that backdrop, and Australia's been carried along.
It's a fickle market, Matthew, because when those first comments came out last week from Jerome Powell, the market actually fell because all of a sudden there's, hold on, he wants to cut rates. Maybe there's a recession in the future. And so it dropped and then it's risen again. How do you see through all the noise? How do you actually work out and determine what is actually happening?
Yeah, it's hard because, as you know, that interest rates have a lag effect. It takes a while before higher rates actually impact the economy. And it's been that way this time, very clearly. In fact, the lag's probably been 12 months rather than the usual 6 to 9 months. So even harder to predict. And we don't know for certain. I mean, that's what makes markets. We don't actually know what's in front of us. But the market will try and predict 12 months ahead. And even, as I said, we're going through a slowdown period. Unless we fall off the edge of a cliff and it's a nasty recession, I think the markets globally will look through and say, well, we're getting rate cuts. That means 12 months, 24 months down the track, economies will be growing stronger again. And so let's take off the table a bad recession. We might get something mild, flat to nothing growth, or maybe a slight recession. That's good enough for this market to get going higher.
In terms of investing then, people keep saying it's a stock pickers market. It's probably always a stock pickers market. But when you've got these big macro factors kind of carrying the market one way or another, it does actually question whether, when does it come back to fundamentals?
Yeah, exciting stuff because markets are going higher. But to outperform, which we're all trying to do, it's very difficult to work out because previously when interest rates or inflation reached peak and everyone started to talk about interest rates coming down, where did they buy? They bought those structural growth stories. In the US, it was the Magnificent Seven that grow regardless. Lower interest rates means that you change your discount rate, which means that stocks are worth more. And so that worked. But what we saw last week is with these lower inflation figures was a massive switch over a couple of days out of the NASDAQ stocks, high growth, into what they've got as the small cap index, the Russell 2000. Now, I don't know if that's sustainable. A couple of days doesn't mean a trend is in place, but it is something we've got to have a look at and work out what grows or what performs into the future. And it's not easy. And in Australia, we don't have the Magnificent Seven. So it's even murkier here, and you've got to pick your way through it. My personal view is if we believe rates are coming down, and I'm one who believes that the economists have fundamentally got it wrong. We're going to get an interest rate cut in Australia by the end of the year sometime. It won't be before September. It might be November, December, depending on when the meetings fall, because the economy has slowed. And if we get any relief on inflation between now and then, we'll get a cut. And the Reserve Bank is probably seeing numbers now that are pretty ordinary from an economic point of view, including unemployment gradually edging up. So we've got to work our way through. My view is that you don't go cyclical yet. You stay with the structural growth stories, because the economy over the next 6 months is not going to help you. And cyclical stocks that depend on the economy doing well will give you bad numbers. So structural growth for now. And once we get into the interest rate cutting cycle, you probably switch and look for those cyclical style stocks.
Okay, we don't have the Magnificent Seven, but we do have the big four banks here. And in terms of the actual market doing so well, the fact that Commonwealth Banks run hard, same with National Australia Bank and Westpac and ANZ to a lesser extent, because they're such big parts of the market, they really have pushed the bourse beyond that 8,000 point mark. What do you mean? Can you keep, based on what you just said, can you keep buying the banks?
Well, you know my view on the banks, especially CBA, it's expensive. But it has become the proxy for the Australian market to go higher. That's where the gains in the index have come from. I would say that you have to lean back on what you're taught, and valuations are important. If we do get interest rate cuts, we know that the housing sector will probably fire up, and that's good for the banks, because that's the lion's share of what they do these days. They're residential lenders as opposed to more broadly business lenders or economy-wide lenders. So that would help. I would think you watch the results. If you want to stay in banks, which I'm not saying don't do it, you watch the results coming up. We'll get some quarterlies and the Commonwealth Bank half year, and you maybe pick two that are doing well rather than just being pre-committed.
Stay with me, Matthew. We'll be back in a minute. My guest this morning is Matthew Kidman, Principal at Centennial Asset Management. You mentioned the Russell 3000 earlier on. The small cap index in Australia has been going to outperform for years now, yet over the last 2 or 3 it's underperformed the large caps. Where are small caps up to at the moment, and how should we think about them going forward?
Yeah, so we had that switch last week in the US, and there are signs that investors want to get exposure to small caps in Australia, but it hasn't shown up in the index. Say in the last week or so, as we've gone to these new records, smalls have probably performed the equivalent to the bigger index, the 200 in Australia. So I think that will come a bit later than what we're saying. As I said, I think you've got to stick with structural growth stories. And a lot of those at the moment, because you get that benefit of maybe lower interest rates, not only official rates from the Reserve Bank, but importantly, bond yield rates, which are now coming down around the globe. We talked about the US. Well, Canada's gone. It's cut, and so is European Union. The US will, and we're, as I said, just lagging, but we'll cut at some stage. So structural growth is stories like Goodman Group, Cochlear, some of the bigger companies that can grow low double digits in that environment. So I think the smalls will perform, and some of the lead stocks in that will perform, but I think it will really kick in once you have 2 or 3 interest rate cuts, and because it's more exposed to the domestic economy, and the domestic economy needs to start firing up again. And I suspect that's 12 months away.
Okay, so you mentioned Goodman Group there. You mentioned Cochlear. They're 2 of your favoured stocks at the moment.
We own Goodman Group. We don't own Cochlear. I'm just saying we're mainly small caps, but I'm just talking about companies that tend to be able to grow regardless of the cycle because they're on their own path. There's others in the market. You might want exposure because the US is ahead. You might want exposure to the US housing market. You buy James Hardie at that big end. Smaller stocks, whether they be retail, whether they be building materials, or even software companies, industrials in general, they're exposed to the domestic market. So a lot of them don't have structural growth stories. I mean, some do, but most of them rely heavily on the local market, local economy. And so their time will come, and I think they will catch up. And when they go pretty hard. But I think we will probably see those, the big cap index probably pace it for a little bit longer. But I'm optimistic.
We're a couple of weeks away from earnings season. It starts in August. What do you expect from that?
Mainly disappointments because the economy's slowing. But I think what you'll do is you probably want to, if you can, avoid the absolute bombs. There's always some horrors, but there's also some surprises. And you've got to pick your way through it and just avoid stuff that it's probably going to give you a bad indication of where things are. I've talked about the consumer, so retail, the automobile retailers, and media, those things that are very much domestic related. I would say avoid that for the moment and just see the results, because I suspect there's downgrades. So, but then the structural growth stories, they'll continue to grow, and they don't have to grow at astronomical rates, but I think the market will watch it. It'll be a bit choppy during August, and then it will go higher again. What people forget is that we've been in a bull market for a while now. It was in October 2022 that the NASDAQ bottomed. It was the lead indicator. That's the big index of the world now that we all follow. Other indexes soon followed later. As I said, Australia 12 months, maybe 9 months behind the US, and we bottomed in October 2022. And so we've been going up ever since. It is in my eyes, another bull market, but it's also the last leg of something that started in 2009. So we're 15 years in, not unusual that markets go for that extended period. We went from 82 to 2000. We went from the late 40s into the mid-90s or to 1966. They were big bull markets. And I think we're going to have the last leg of it, and it started last October for us and could last for 2 or 3 years, and we should get above average gains in that period.
Final question. I know you are sports mad, Matthew, always has been. Will the Swans win the flag, and who will win tonight, Queensland or New South Wales? 2 questions, in fact.
Yes, so the Swans, they are the standout team in the AFL, and it's theirs to lose. I think they should win it. They definitely make a grand final. They've got to perform on that day, so I'm tipping them. In terms of state of origin, it's at home in Queensland. They should win, but I suspect that we will have an upset and that New South Wales will win. And the main reason is that Queensland's team is, unfortunately for them, not that good. So they'll have the home ground advantage, and they're the favourites, as I saw the betting last night. But I think this could be the outlier where we buck the trend and history is wrong, and New South Wales get the chocolates.
So there you go. We've got the Swans, we've got New South Wales getting the chocolates, and we've got an interest rate cut by the end of the year. Matthew, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Matthew Kidman from Centennial Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.